If I told you that Lucid losing $1 billion a quarter or Uber throwing cash into bleeding projects isn't a sign of panic, but a life or death gamble to avoid being wiped out by Tesla, would you believe me? In the world of investing, a loss on a balance sheet rarely tells the whole story. Today, we're going to decode the art of the burn and the real reason why Uber is quietly building a hardware empire just to stay alive. Welcome back. This week, the numbers hitting the tape are honestly wild. Lucid just posted a $1 billion net loss. BYD, the so-called Tesla killer, is seeing sales slide in its home turf. And then there's Waymo reportedly losing a staggering $100 on every single ride they provide. On the surface, it looks like a total market meltdown. But while the headlines scream disaster, Tesla is quietly reclaiming its throne, proving that efficiency is the ultimate weapon. Most analysts are calling these competitors failures, but they're missing the bigger picture. This isn't just about bad earnings, it's a desperate high-stakes evolution. Are these companies just cash furnaces, or are they building the infrastructure for a future where Tesla doesn't own everything? To understand why Tesla's rivals are bleeding out right now, we need to take a step back and look at the bigger picture. We need to go back to the darkest days of Tesla's own history to see if these burners are building a bridge to the future or just burning to stay warm. To understand why Tesla's rivals are bleeding out right now, we need to take a step back and look at the bigger picture. We need to go back to the days when Tesla itself was on the brink of collapse. You see, in the tech auto world, cash burn isn't just a scary term on a spreadsheet, it's an inevitable phase of evolution. But there's a massive difference between burning money to build a bridge to the future and just burning it to stay warm for one more night. Let's look at the numbers, because they don't lie. Right now, Lucid is the poster child for this cash burn crisis. In Q1 of 2026, Lucid reported a staggering net loss of over $1 billion. Now, here's the kicker. Their revenue actually increased by 20%. Think about that for a second. You're selling more cars, you're bringing in more money, yet your bottom line is sinking deeper into the red. Why? Because in this industry, scaling is a monster that eats capital for breakfast. For Lucid, every car rolling off the assembly line represents a massive loss. When your production volume is low, your fixed costs, the factories, the machinery, the R&D, are spread across too few units. It's a math problem that has claimed dozens of startups before them. But wait, didn't Tesla do the exact same thing? Yes, they did. Between 2012 and 2018, Tesla was burning billions. However, Tesla was burning that cash to build the gigafactories, to secure the battery supply chain, and to create the supercharger network, infrastructure that no one else had. They were building a moat. Lucid, on the other hand, is burning money in a world where the moat already exists, and Tesla owns it. When Tesla was at its lowest point, it had a clear path to positive margins through volume. It was the only viable player in the premium EV space. Today, Lucid is fighting for scraps in a saturated market, facing off against a mature Tesla, a surging Xiaomi, and traditional giants who have finally woken up. If we dive deeper into Lucid's Q1 2026 filing, the red flags aren't just in the total loss, they're in the operational efficiency. Even with that 20% revenue jump, their cost of goods sold is ballooning. They aren't finding the economies of scale that Tesla found at this stage. Instead, they're stuck in a cycle of high incentive sales just to keep the inventory moving. This brings us to a hard truth for investors. Cash burn is a tool, not a death sentence. When Tesla burned cash, it was an investment in a monopoly. When Lucid burns cash today, it feels more like a desperate attempt to keep the lights on while waiting for a miracle, specifically their upcoming mid-size platform. But as we know, the market doesn't wait for miracles, it rewards results. The production hell Tesla faced was a temporary bottleneck to a global scale. The financial hell Lucid is facing looks more like a structural flaw in a high-interest, high-competition era. You have to ask yourself,
Are they building the next global giant, or are they just an expensive hobby funded by the PIF and, surprisingly, Uber? And that brings us to the most interesting twist in this story. If Lucid is bleeding so badly, why on earth did Uber just decide to double down on them? Why did they pump another $200 million into a company that seems to be a cash furnace? The answer isn't in Lucid's balance sheet, it's in Uber's fear of what Tesla is about to do next. But before we get into Uber's secret hardware play, we need to look at the other side of the world.
Because while the Americans are burning cash, the king of the Chinese EV market, BYD, is facing a crisis of its own. And this one might be even more dangerous for your portfolio. Let's talk about why the Tesla killer is suddenly losing its grip. Many people are laughing at Uber right now. They see Uber pumping an extra $200 million into Lucid, a company that's practically a cash furnace, and they think this is a desperate move. But if you want to be a successful investor, you have to stop looking at the price tag and start looking at the chessboard. Uber isn't just buying cars, they're buying their right to exist. For over a decade, Uber's entire success was built on being asset light. They didn't own the cars, they didn't employ the drivers. They were just the genius middleman with a great app. It was a perfect high-margin model until the word autonomous changed everything. Enter the Tesla Cybercab. Imagine a world where Tesla launches a massive fleet of self-driving taxis. These cars are cheaper to run, safer, and integrated perfectly into the Tesla ecosystem. In that world, Uber becomes an obsolete icon on a screen. If Tesla owns the software and the hardware, they don't need a middleman. Uber's biggest nightmare is waking up to find they are a ghost app with no fleet to command. This is why Uber is pulling a massive U-turn on its strategy. They're moving from asset light to asset heavy. They're pouring money into Lucid and Nuro because they desperately need hardware partners who aren't named Elon Musk. Think about it from the perspective of Uber's chief strategy officer. You have billions in the bank, but you have zero manufacturing plants. You see Tesla pulling ahead with vision-based autonomy. You see Waymo expanding. What do? You find the best engineered EV on the market, which, despite its financial struggles, is arguably the Lucid Air or the upcoming Gravity USV, and you hook them to a life support machine. That $500 million total commitment to Lucid, that's not an investment in a car company's stock. It's a down payment on a survival kit. By securing 35,000 Robotaxi-ready vehicles, Uber is trying to ensure that when the driverless revolution hits full scale, they actually have a physical seat at the table. But here's the twist. Lucid has to survive long enough to deliver those cars. Uber is betting that their massive data network and cash injections can act as a bridge for Lucid to reach its mid-size, more affordable platform. It's a high-stakes alliance of two players who are terrified of a Tesla monopoly. If you're an investor, you have to ask, is Uber's asset-heavy pivot a brilliant defensive move, or are they just tying themselves to a sinking ship? The data suggests Uber is flailing, trying anything to see what sticks. They've invested in Lucid, they've invested in Nuro, they're partnering with anyone who has a sensor and a dream. It's a Neapolitan strategy, mixing different flavors hoping the result is edible. But while Uber and Lucid are busy trying to figure out how to work together, Tesla is already collecting billions of miles of real-world data every single day. And that brings us to the ultimate bottleneck in this race, the data. Uber claims they have a clear advantage because they have millions of drivers. They think they can turn every Uber on the road into a rolling data collection rig. But there's a fatal flaw in that logic, a lie so egregious it could cost investors everything if they believe it. To understand why Uber's data play might be a total illusion, and why Waymo, despite its technical brilliance, is losing $100 every time someone clicks Request Ride, we need to look at the sunk cost trap. Let's talk about why the best widget in town doesn't always win the market, and why Google's ego might be the only thing keeping Waymo's sensors spinning. Now, let's talk about the most dangerous phrase in investing. We've already spent so much, we can't stop now.
This is the sunk cost fallacy, and it is currently haunting the boardrooms of Google's Waymo and even the giants like BYD. Let's look at Waymo. Technically, their cars are brilliant. They've mapped every millimeter of San Francisco. But from an investment standpoint, the numbers are terrifying. Wall Street expects Google to lose $5 billion on Waymo this year alone. If they hit their target of 1 million rides a week, that's still a loss of roughly $100 per ride. Why is it so expensive? It's the LiDAR trap. Waymo's cars are rolling labs. They're packed with expensive sensors, LiDAR, and massive onboard computing power. Every time they want to expand to a new city, they have to pre-map it with insane precision. It's a brute force approach to autonomy. Google has invested so many billions over the last decade that they suffer from a massive sunk cost ego. They were the first, so they feel they must be the winner. But compare that to Tesla.
Tesla chose the vision-only path. No LiDAR, no expensive pre-mapping, just cameras and neural nets mimicking how a human brain works. One approach costs tens of thousands per car and hardware. The other uses cameras that cost a few $100. While Waymo is losing $100 per ride, Tesla is collecting data from millions of cars that customers already paid for. That is the difference between an R&D project and a scalable business model. And it's not just the Americans struggling. Look at China. For months, the headlines said BYD had finally dethroned Tesla, but in Q1 of 2026, the reality set in. Tesla officially reclaimed the crown with 358,000 deliveries versus BYD's 310,000. Why the sudden shift? BYD is facing a middleman crisis. They grew too big, too fast, focusing on the low-end market. But now, tech giants like Xiaomi are entering the fray with fresher designs and better software integration, squeezing BYD's margins. BYD is finding out that being the old man on the block in the EV world is a liability, not an asset. They're stuck with massive factory overhead for older models, while Tesla has already retooled for the next generation of efficiency. So, as an investor, how do you tell the difference between a company investing in the future and one trapped in the past? Here's your toolkit for reading the red flags. First, look at factory utilization. If a company like Lucid is only using 10% of its factory capacity, they're literally burning cash just to keep the lights on. Tesla's factories are optimized to run at near maximum capacity, which drives the cost per car down. Second, look at the moat. Is the company building something that gets cheaper as it scales? Waymo gets more expensive and complex as it expands city by city. Tesla gets smarter and more profitable with every mile driven by its fleet. Third, and most importantly, check the pivotability. A company stuck in a sunk cost trap will refuse to change their hardware because they've already spent billions on it. Tesla has shown they're willing to rip out ultrasonic sensors or radar overnight if the data shows a better, cheaper way. The market in 2026 is no longer rewarding potential, it's rewarding survival and margins. While Uber, Lucid, and Waymo are busy forming alliances of necessity to share the burden of their losses, Tesla is standing alone at the top, not because they're lucky, but because they avoided the traps that are now catching everyone else. But where does this leave us for the next 12 months? Are we looking at a total monopoly, or is there one black swan event that could still level the playing field? In our final section, we're going to look at the 2027 forecast, and I'll show you exactly what I'm doing with my own portfolio to prepare for the great EV shakeout. So what have we learned today? The EV and Robotaxi race isn't just a business competition, it's a high-stakes war that is definitely not for the faint of heart. Tesla has arguably won the first half of this game through sheer operational efficiency and manufacturing scale. But as we enter the second half, the era of full autonomy, the stakes have shifted. Every player on the board is now betting their entire fortune on a single outcome. As an investor, the biggest mistake you can make right now is getting blinded by the headlines. Don't just look at the EPS or the quarterly delivery noise. Instead, follow the cash.
Look at the free cash flow, and more importantly, look at who is actually building the infrastructure to dominate the streets. Is it the survival alliance of Uber and Lucid trying to patch together a hardware-software bridge? Or is it the unified, vertically integrated control ecosystem of Tesla, which owns everything from the vision code to the charging cable? One thing is certain, the great EV shakeout is here. Some of the names we talked about today will likely not exist in their current form by 2027. They'll be absorbed, liquidated, or turned into mere suppliers for the giants that remain. Now, I want to hear from you. If you had $10,000 in your hand right this second, where would you put it? Would you bet on Tesla's proven machine, or would you take a contrarian play on the Uber-Lucid underdog alliance? Drop a comment below with your number and your why. I read every single one, and we'll be diving even deeper into these portfolio strategies over in our private member group. Invest with your head, not your emotions. Stay sharp, watch the data, and I'll see you in the next one.